Hey everybody, Tim Albrecht here. Welcome to this week's episode of Ask a YFP CFP segment of the Your Financial Pharmacist Podcast, where we feature questions from you, the YFP community, to be answered by one of YFP Planning's fee-only certified financial planners. Before we jump into today's question, a shout out to YFP Planning's incredible planning team that makes this segment possible. YFP Planning offers fee-only comprehensive financial planning that are customized to the pharmacy professional. So whether you want to develop an investing plan, pay off the student loans, or simply build a solid financial plan, YFP Planning will help you get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. Okay, this week's question comes from Andrew, and Andrew asks, with the current downturn in the market, I've heard about tax loss harvesting as an option to offset future capital gains in the market. Can you talk about what tax loss harvesting is, how it fits into the financial and tax plan, and when to utilize this strategy? Can you also discuss reinvesting the money to avoid the wash sale rule? Tim Baker, what are your thoughts?
Yeah, so this is something that we haven't really talked about at much, or if at all, tax loss harvesting and wash sale rules. One, because I would put it in the category similar to what we talk about with like that backdoor conversions. It's just like, it can be too complicated for, a forum like this, to be quite honest. So, I don't like talking about it because I think some people, they make it simpler than it actually is. So there is a place for tax loss harvesting. I would say less so like for wash sale type situations. But it's really when you have a lot of your assets tied up into like taxable accounts, which for a lot of our clients and probably a lot of our listeners, that's not necessarily should be the case. So to define tax loss harvesting, Tim, it's a strategy that reduces an investor's taxable income. So basically what you try to do is sell a security at a loss in order to report a capital loss on your taxes to offset any capital gains you have. So example of this is, I buy a security that at 100 and basically I sell it for a loss at 90 to offset that a different security that I bought at 100 and that I sell for a gain at 110. So basically the gain of, again, and there's short-term gains, long-term gains, short-term losses, long-term losses, they have to cancel each other out. But this is basically, in essence, what tax loss harvesting is. So if you think that you're going to, you bought a stock that was a winner and you're trying to minimize your tax exposure for that tax year, you might look at some of the poorer performing investments and sell those to offset some of that gain. So it just reduces your tax exposure. So that's really what you're trying to do. And again, long-term capital gains are taxed a lot more preferentially than short-term, which kind of goes to what I'm going to talk about with the wash sale rule, is that when you're buying and selling and day trading or just trying to time the market, one, is really hard to do, but two, it doesn't help you from a tax perspective because what Congress and the IRS are trying to do is reward people that are actually making investments, not speculating. So if it's short term, that's going to be taxed at ordinary income, which is typically a lot more than what you see for long-term capital gains. So to get down into the wash sale rules, I'm going to kind of talk about the what, the why, the how to avoid them, and the who here. So what a wash sale is, so the IRS defines a wash sale as it occurs when you sell or trade a stock or security. It's typically a stock or bond. So all securities are under this, but typically the focus is on stocks of bond. When you sell or trade a stock or bond at a loss, and then within 30 days before or after the sale, you buy a substantially identical stock, acquire a substantially identical stock or security in a fully taxable trade, acquire a contract, or this either like options, or acquire a substantially identical stock in your IRA or Roth. So it does even bleed into the IRA world as well. And what trying to do, what the IRS is trying to do, what Congress is trying to do, is the purpose of the law is to prevent a taxpayer from recognizing a loss on their taxes without any actual change in their economic position. So if I buy a position at 100 and I sell it at a loss for 90, then that's not like one event, because what they're looking forward is 30 days into the future. If you buy the same or a similar type of position, then you basically have to disallow that loss. So that's what they're trying to do here. So people that buy and sell stocks and bonds, and again, mutual funds and ETFs are part of this as well, but they're less so. There's penalties and there's consequences of doing that if you don't know what you're doing. So really the way to avoid that. So the question is like, how do we avoid this? I would say first, more broadly, don't trade actively. We are a big believer at YFP Planning that, to me, passive investing, also called indexing, is a better way to go than this active market. And again, this has been an evolution for me, Tim. When I was younger, before I was even in the industry, and then even when I got in the industry, I thought that I was smarter than the markets, and it's just not true. So what passive is it's based on the concept that the markets are efficient in price and securities, and you're really unlikely to outperform the market on a consistent basis. So really, the approach is a generally well-diversified portfolio that has low turnover rates, so not a lot of buying and selling. Basically leads to a savings of time, but it also leads to lower taxes and lower operational costs, which could be, associated with trading costs or things like that, or disallowed losses. So it's really more about, so this is me on my pedestal, really more about, kind of agreeing upon and setting a process up a proper asset allocation. And what I mean by that is, am I 80% in stocks and 20% in bonds, or 90% in stocks and 10%? That's really the big piece here. You then try to buy the market. Don't try to beat the market. You purchase things that are low cost, and you rebalance that a couple of times a year. The don'ts in the philosophy is don't try to time the market or speculate, which is a lot where wash sale stuff comes in. And I would say if you need to scratch this itch, it should really be 95, maybe 90% of your portfolio should be in passive indexes, and the 5 to 10% that you need to kind of scratch that itch, that's what you use that for. And I would say closer to 5. To me, it's not about picking home run investments. It's really passive is like a singles and doubles approach, because the market takes care of us over a long period of time. Don't have the mentality to beat the market. And then just don't make investing sexier or more interesting than it is. I would say that typically the more sexy or interesting investing is, typically the worse it is for the investor, because you're chasing returns or it's more expensive to you for whatever reason. So that's me. And then I would say even a little bit less broadly, what are you doing in the grand scheme of things? Like, to me, your taxable account, outside if there is maybe a more medium-term goal of like, hey, I want to buy an investment property in 5 years or 7 years, like that's more of a medium-term goal than maybe you do a taxable account. But I would just want to make sure that you're maxing out your 401k, 403b, TSP, a 457 plan, if that's out there, your IRAs and your HSAs before you even get into this, which a lot of people kind of do that out of order. But then more particular to the wash sale is like, ways to get around this is you stay in cash for 30 days following the sale.
Mm-hmm.
So you avoid that by getting to that 31st day, and you're not doing anything. Now, people that are actively trading, there's opportunity cost there, because they think in their mind that they're going to make this great trade in 2 weeks or in that day, and it's going to change their life, which you can debate that. The other way that you could do is you can buy something else that is similar but not substantially identical. So this is not investment advice, but this is where you would just to illustrate the point, you would sell Ford and buy Chevy. Those they're similar, but they're completely different, companies with different leadership, et cetera, data, all that stuff. So, but however, the rule for substantially identical is there's a lot of ambiguity, Tim. So like you're kind of leaving it to your own devices to say what that is. So you have to rely on case law rulings and your best judgment. And the IRS has said that ordinary stocks or securities of one corporation are not considered substantially identical to stocks or securities of another corporation. So that's something to consider. And like I said, this is mostly focused on individual stocks and bonds. For mutual funds, I even put ETFs there. There are differences in the proportions of the underlying securities. how the fund is managed, how they identify the manager, and allow, different objectives and things like that. But I think if you do have ABC total market and, XYZ total market, that could be considered a disallowed loss if they're very similar in nature. And the last thing I want to kind of talk about is the who, Tim. At the end of the day, you are responsible for reporting what can be deducted and what can't. It's not your brokerage firm, although, some of the newer brokerage firms are trying to help you with this. It's not your financial advisor or even your tax advisor. And I would say this because we had some clients be surprised by a tax bill because of activities related to this, wash sale rules or disallowed losses. And again, if you're doing this, it should be very minimal. So it shouldn't have a great effect. But it's the analogy that I give is almost like if you're managing that and you're maybe working with someone else, an advisor or a tax professional, it's almost like, this might be a poor analogy, but it's almost like I'm taking 3 medications and I'm only telling my doctor or my pharmacist about 2. Like I can't see what's going on in that for that 3rd medication, and there could be negative effects. So to me, a lot of this goes back to the overarching knowledge of keep it simple and don't overcomplicate things that don't need to be complicated. So to me, if you're going to do this, you should understand this. And it's a complicated thing because even there's scenarios where with a wash sale, you buy 10 shares, but then you only sell 5. So then there's a whole process of like, increase in basis and change in time horizon to affect that 30-day timeline. So it's a lot more complicated than people think. And unfortunately, there's not like a easy button where everything spits out for you. And it's like, this is what you have to report and things like that. It's getting better. But to me, I would say more broadly, keep it simple, keep it boring. Investing, I think, in my opinion, should be as exciting as paint drying. And people don't like that because they think of like, oh, I like, I've always been a big fan of like Tesla, but that might not be a great investment. Like there's bias in that too. So like, I like this type of car, or I like this type of technology. That doesn't necessarily mean it's a great investment. So those are things, again, that, I would say keep it simple, buy the market, keep, costs low and, save your time. But those are some of the nuances of tax loss harvesting and wash sale rules.
When Tim Baker drops a pharmacy analogy, it's a good day. It's a good day. I love your example of like taking a few medications and all that. That's a great one, for folks that are working with someone. I want to jump on the passive investing soapbox with you for a moment, because you mentioned 2 things, and I think you alluded to the third, but I want to really hammer the point home. You mentioned, obviously, there's the tax considerations and costs. There's the operational cost consideration. Let's not also forget the biases in human behavior that comes from having your hand in it more often than not, right? So there's research out there to support this. We can just live from firsthand experience, and especially talking in a volatile period of the market that is right now. The more you're in it, making changes, looking at things, the more likely you are to make some of the behavioral biases that do not work in your favor when it comes to long-term investing. Now, that's not for everyone, all type of rule. But generally speaking, I know even just myself, the more I'm looking at, hey, what's the market doing today? What's the market doing today? What's the market doing today? You start to feel some of that, like, oh, maybe I should cool off a little bit, or maybe I should change the game plan, or maybe I should move in or move out, or maybe I've got too much domestic. I should be doing more international. Maybe I should pivot to real estate. And all of a sudden you get in a hour to hour, day to day mindset instead of, hey, we're trying to go 30 years. And we've had so many examples over the last 3 years. And I said this before on the show, front page or the Wall Street Journal, if you were to make your investing decisions based on the news of the day, you literally would be in and out every other day.
Yeah. And so much is, it's so behavioral. And again, like I've been humbled. I mean, outside of Warren Buffett, who can buy companies and like extract, profit and things like that, like there's very little people that can predict what's going to happen in the market. It's just really hard to do consistently over long periods of time. And that's why I'm a big passive versus, an active investor. I believe in that. And there's a lot of books, and I think in science to support that. And yeah, you might have years where active investor, like, but it's, if we're talking about a 30-year time period, there's a parable. I think it's a parable, but there's it's always stuck with me is like, you have an investor who has $1 million and another investor has the same $1 million. One steps off a curb and gets hit by a truck and is in a coma for the rest of their life. They're going to they're going to do a lot better from an investment perspective than the person that has $1 million that's buying and selling every day. Because you're wired to, like loss aversion and things like that. And the way that I keep score in my head, it's one, I don't really look at it, to be completely honest. Like I don't look at my own stuff because it makes I'm like, oh, there's X amount and now there's X amount minus 20%. But I know over the long period of time, since the stock market's been around, it's going to return 10%. We adjust it down for inflation, it's closer to 7. Those are good. Like those are solid returns. That's going to get people where they need to be, especially if they've been doing this over decades of, a solid investment plan. The other thing that I kind of square in my head is that when it's down, I'm just thinking about the dollar cost averaging that I'm doing into my 401k or other investments, my 529, maybe a taxable account, where I'm like, all right, now those dollars are going further because I'm buying them at a discount, so to speak. So, it's one of those things of like you come up aces on both sides. So if the market's up, you're like, oh, this is great, but that's fugazi. It doesn't really mean anything because I'm not like selling the investments to retire today, at least not in my case. But if it's up, I feel good because it's up, because the balances are saying I'm worth, X. If it's down, I'm winning too, because I'm like, well, the money I'm putting in, or I'm trying to put more money in because I'm buying it on sale. So like that is, and to me, like it's going to come up and, it's going to, outpace. So, we show in some of our investment talks, we show this, 2 portfolios, one that's consistently going up and one that's more of a smile. And it's a little bit of it's unbelievable, but the one that like starts here, goes into a smile and then ends in the same, like that portfolio is typically worth more because your dollars at the bottom of that trough there are just going further in terms of shares. So when the share rebounds, the overall portfolio value is a lot higher. So this goes back to behavior. Again, I don't necessarily like talking about this topic because I just think it's more complicated in this forum. There's lots of YouTube videos out there that, even when I direct people to watch them, like it's still confusing. And it's the same thing with we show that, that decision tree of like when you should do a conversion and things like that. And it's just more complicated than people think it is. So I'm hesitant to say like, oh yeah, this is the way this particular part of finance works.
Yeah. And since you mentioned Warren Buffett, I just finished reading his biography called Snowball, which is a great read. And I think really highlights why he himself, when you hear him talk about the complexities and the research that he's done and the decades of experience and the risks that he took along the way, it's more understandable why he gives the advice for the vast majority of the population.
Indexing.
They should not be doing what he himself is doing.
And I think in his trust, from what I understand, Tim, is in his trust. I think like when he dies, like he's directed his trust, I believe, to be in like a low cost indexing investment strategy for his dependents. So and there's lots of people that are like, obviously he's one of the more prominent ones that have come out and said like indexing is the way to go. But there's a lot of people smarter than me that are believers of that. And again, like I understand scratching that itch and I think the first stock I ever bought was like a stock of Johnson & Johnson, not investment advice. This is like way back when. And it's like, why did I just buy one stock? Talk about like a waste of like a trade because of, that, but like, it's just, I wanted to see how it worked. And I understand that. I don't want people to like hear this and be like, oh, I'm such a curmudgeon and I'm shaking my cane at you as you're running through my yard. Like I understand it, but I've also been humbled by the market thinking like I know more. Cause thing that you read about that biopharmaceutical stock or whatever, that's been priced into the market even before it went to print, to be completely honest. Right. So it's just understanding that and understanding that you have biases and you might not be able to see them, but they're there. And that doesn't necessarily make you a great investor. So, and then there's just a lot more complications when you're doing that in terms of like taxes and operational costs, like as I mentioned.
Yeah. And one of the things I try to remind myself is that number one, I have biases. I think the more you learn about the cognitive aspect, the more you are aware of those, and also the overconfidence. That was my highlight. I mean, obviously I follow and believe in a very passive investing approach, but I think like many people, you're interested in this and that time in the market. And especially after reading that Warren Buffett book, like it was a good notch back down of like any hint of overconfidence was a good reminder of like, no, don't have it. Stay the course. And also just the value in time. Not to say, to your point, you can't do it. There's not value, or it can't be something enjoyable to research and even participate at some level as a hobby, but make sure we're controlling, the impact that it can have with the rest of the portfolio.
Yeah. And overconfident. I mean, it's a tough one to even call out because it's like, we see that a lot. And, like, how do you say that without kind of coming off as like a jerk?
Sure.
It's like, hey, Tim, I know based on the conversation that you're feeling good about X, Y, and Z, but like you're showing signs of being overconfident in your position. And I think that's a lot of this is like, it's a slice of humble pie. So like, I think some people, like when I first got into the industry and I'm like, wait a minute, you're just buying the market. Like what a cop out. Like, why aren't you trying to like improve your situation? But it's the market, I think is efficient. And, to me, it's presumptuous to think that I can like outsmart it on a consistent basis on my behalf or on my client's behalf. And I think it's even harder than it was even back in the day, because now you're basically competing with algorithms. You're competing with, and there's whole like books about how like that's really changed the process in terms of like, fair pricing and that type of thing for the average investor, so, to me, I think it's smart. It's a smarter position to recognize that you're not as smart as the market and really focus on the things that matter, which are beyond the scope of like, what are we actually picking for the investments? To me, the value that, you can provide for yourself or that an advisor can provide for you is just well beyond that, in my opinion. So, yeah.
Great stuff, Tim. And thanks again for everyone listening to this week's episode of Ask YFP CFP segment. Andrew, appreciate the question. We're going to be sending you a super comfy YFP t-shirt. And for folks that are listening that want to have their question featured on an upcoming episode, 2 ways you can submit your question. Number one is you can send us an email, info@yourfinancialpharmacist.com, or you can go and record your question directly by visiting yourfinancialpharmacist.com/ask YFP. So as we wrap up this week's segment, an important reminder, as Tim mentioned a couple of times, the content in this episode is really for informational and educational purposes only, is not intended to provide, should not be relied on for investment or any other advice. Information in the podcast and in our corresponding materials should not be construed as solicitation or offer to buy or sell any investment or related financial products. For more information about this, you can visit yourfinancialpharmacist.com/disclaimer. Thank you again for listening. Have a great rest of your week.